Good morning and welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I'm your host, Jen Sanasi, here with my co-host, the TIE Director of Content, Lawrence Lewitton. Good morning, Lawrence.
Good morning. How are you?
I'm great. Always wonderful seeing your face first thing in the morning. Let's take a look.
Nobody has ever said that.
Well, I am glad that I hope it's joyous, that it's wonderful to see your face first thing in the morning. I'm glad I could bring that joyous note to you.
No, that's, yeah. You're spared. You're in a different country.
That's true. There's a lot of space. All right. Let's take a look at what's going on in the markets this morning. The CoinDesk Bitcoin price XPX index is at 29,113, holding steady this morning around that 29K mark. Let's take a look at Ether. The CoinDesk Ether price ETX index is also holding steady over the past 24 hours at 1,853. And I predict that DeFi assets are doing much of the same thing. The DFX CoinDesk's DeFi index at 122. Not a lot of movement in the last 24 hours. One project that has seen a lot of movement in the last 24 hours, Worldcoin, our top story is focused on the crypto token tied to Worldcoin's identity verification project. Of course, we spoke about that on the show yesterday morning. The token is seeing its initial gains erased as the crypto community expresses concerns about the project co-founded by OpenAI's Sam Altman. Lawrence, I know you've been watching the project closely. You're writing about it in your upcoming newsletter. What do you make of those big gains we saw yesterday and them all going away this morning?
It went away fast. I mean, actually, we got off the air, because we spoke to somebody from Worldcoin yesterday, of course, which you should all watch. And shortly after, I mean, we just saw the sell-off happen in Worldcoin. It doesn't erase, obviously there's always enthusiasm when a new project launches. It has Sam Altman, that's oh, hey, ChatGPT guy, what could go wrong? And it just seems as if the market just stepped back and said, wait a minute, this is a lot of the value proposition of this isn't quite there. It's a lot of steps, and even those steps that do happen, and it was a topic that we brought up here. It feels like it might be some exploitation of people. The other thing is that, they're reading Vitalik's critique of it, and Zach XBT also going off on it, and a lot of people are just like what is this nonsense? So it's not going to necessarily be this. Don't put your mommy's money in this, okay, everyone? Just no.
It is a project with a lot to digest. There's the universal basic income piece. There's the proof of personhood piece. There's a wallet and a whole ecosystem and a token. I think maybe some people might have been using the token as a way to bet on Sam Altman. But like you said, Lawrence, maybe reading some of the critiques and challenges that were outlined in the multiple stories and blogs that were published yesterday.
Yeah, the universal basic income aspect to it is, in many ways, there's so many steps that have to happen. Mm-hmm. And I've got news for everybody. Governments have been able to hand checks to people for decades. Like the first Social Security check came out in the 1930s, almost 90-something years ago. So I don't know, but everyone's got a handle on that part. Do we really need this? Is this really what crypto's about? I don't know. It's not what I signed up for when I read the white paper.
That's the question. Do we really need this? All right. I'm sure we'll explore that question more as the project continues to develop, but let's take a turn and look at the state of crypto.
The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
All right. The Federal Reserve has a new instant payment service called FedNow. The central bank has also denied that it's tied to any digital U.S. dollar initiative. Joining us now is Brookings Institution Senior Fellow and former Deputy Assistant Secretary for Economic Policy at the Treasury Department, Aaron Klein. Welcome to the show, Aaron.
Hey, thanks for having me on.
Thanks for being here with us. Now, FedNow has been a big talking point over the last few months. Tell us what FedNow is, what it's used for, and what the everyday consumer out there can expect from a service like this being launched to financial institutions.
Sure. So FedNow is the update to the Federal Reserve's clearing system, which is called the Automatic Clearinghouse, or ACH, which has been run on 50-year-old technology. The old technology was kind of like a laundry machine, a batch system where you had to put everything in and the payments were all cleared together. So they were done in a couple of batches throughout the day, ending usually in the early afternoon East Coast time. The result were payments that took anywhere from 1 to 3 to 6 days, depending on if there were holidays or weekends. FedNow is like a streaming service. It's a real-time payment system that goes straight all the way instantly, 24/7, 365. It's what the rest of the world developed 10, 15, 20 years ago, depending on what country. So this is just a modernization of the Fed's back-end payment processing system, which has been sorely needed and long overdue.
Does this change anything with things like foreign exchange? You know, as an old foreign exchange trader, I was going to say, as an old foreign exchange trader, we always had to wait 2 days for everything to clear. Spot was actually the days were 2 days out. Will that have any effect, or will it eventually have any?
No, this is a retail payment system. This is not about trading an institution. At some point, it may be helpful for the Securities and Exchange Commission as they try to go to T+1 and lower the amount of actual settlement time between when your stocks trade. But this is really about retail payments. It's about how long it takes for your check to be available, for your funds, for your paycheck. Most people think direct deposit is instant. They couldn't be more wrong. When you see a direct deposit from your employer show up on Friday, that money probably left the employer Tuesday, and it sat in this netherworld of payment plumbing for 3 days. So it's really a retail system. And unfortunately, it's going to have a pretty limited effect. It launched with, I think, only about 36 banks and credit unions signed up, and then about another 20 ancillary service providers. So it was a pretty tepid launch, which makes sense because the industry gets a lot of money and profit from the delay in the existing payment system.
Yeah, how big was the biggest institution that signed on?
Well, some of the very large institutions signed on, but just because they signed on doesn't mean that they're using it for your payment. See, part of the problem is the Fed has regulatory authority to require money be available sooner, and it doesn't use that authority. It sits on its hands, even though the laws required them to speed up payments for decades now. Some people like myself have hypothesized that the Fed has refused to follow the law requiring faster funds because they didn't build the system. Other private systems were built, and the Fed was afraid that if it followed the law and did its job, it would actually move volume away from its own payment processing system to others. So now the question is, will the Fed follow through with its legal mandate to make funds available faster for consumers now that it's built its own infrastructure? The way to think about it is, you know, if Blockbuster had been in charge of regulation involving streaming, would we have had Netflix? I don't think so. Now, Blockbuster eventually built their own streaming system. They were too late because it was a competitive market. Now the Fed's built its own system. Maybe we're going to finally get faster payments in America.
Now, I said this in my intro, but some people are saying that this new system could lay the groundwork for a CBDC. Do you think that's what's going on here? I have to note that the Fed has said that this is not what's happening. But what do you think?
Yeah, no, this is not what's happening. This is two different conflated ideas that have been joined together. I don't fully understand it. CBDC is nothing new. America has CBDC. We have commercial bank digital currency. Every swipe you make is a commercial bank digital currency transaction. The idea of swapping that first C of commercial for central to create a Federal Reserve digital currency is a pretty radical idea that the Fed has been studying. The Biden administration's Justice Department, I think, kind of put the chill on that a little bit by pointing out the Fed didn't have legal authority for that, and Congress seems, at this moment at least, unlikely to grant them that authority in the short term. But this plumbing update kind of has nothing to do with it. It's kind of like saying, you had a problem, you brought in the plumber and put in some new high quality Japanese maybe toilets in your house, and that sets up a possible renovation to add a third floor. The two things really don't have that much to do with each other.
Speaking of toilets, crypto, how is it affected?
I love talking
ultimately?
Toilets.
Yeah, I can imagine. Sure, who doesn't? But how is crypto affected in all of this? In the sense of, one of the arguments of why you use crypto is that it's quick. It'll be quick and seamless transactions, though it's been neither one if you've actually used it. But is this something that takes a little bit of more wind out of the sails of the potential of crypto?
So it depends how you view that argument, and you nailed it. I couldn't agree more. Crypto had a lot of hype about settlement speed, and it's just failed to live up to that. Visa, Amex, MasterCard process way more transactions per second than any blockchain I'm aware of. And so the idea that crypto was going to be this faster instant settlement was definitely one of the main talking points I heard about crypto for a long time, and it failed to live up to that. Now, the Fed has a faster system, so to some degree that takes some of the wind out of the sails of the talking point, but if you've been paying attention, that talking point hasn't been realized in its own on its own technology. So it's hard for me to understand why those two things would really play. What I do wonder is if in a few years from now, if there's still such tepid take-up on the Fed's real-time payment system, if that's going to cause the Fed to take the wrong impression and say the demand for real-time payments isn't there. Because we know that slower payments cost billions of dollars in late fees, overdraft fees, check cashing fees, payday lending fees. And we know that the banks that have on credit unions and fintechs that have provided people faster access to their own money have seen decreases in overdraft and other fees. So we know faster payments works in solving problems faced by Americans living paycheck to paycheck. Whether those problems are the merit, the concern, and policy attention of the Federal Reserve is a different question. But the argument for crypto that it's faster than existing payment systems has been one that I've struggled to see in truth and reality for years.
Any of us who have owed money to a bookie knows this, that instantaneous payments is important. So when it comes to the consumer, though, what will they see affect them in the meantime?
Very little. FedNow had a quiet. It was very hyped. It was said that the Fed was solving this problem, and then when it was rolled out, it was kind of quiet last week. In part because they didn't have that many institutions. So I don't think the consumer right now, you can't go into your bank and say, please send this by FedNow, right? It's a back office system. Mm-hmm. So until the Fed does a little more regulatorily to require that, the consumer will probably see not as much. You'll see maybe some banks start to offer it. To the retail. It depends at what cost. Some banks already offer expedited funds availability, often for 1% of the deposit, which I think is a pretty steep price, but it could be cheaper than the alternatives.
I guess drawing from some of the challenges you outlined there in terms of, fees when it comes to slower payments, getting to the end user, do you think that if the crypto infrastructure was built out and if we could get these faster payments that this industry has promised for so long, it actually does solve the problem of having these middlemen chip away at fees for the end user?
Well, I mean, it depends because the middlemen are chipping away at fees and they're also providing services, right? So, when you see something like an overdraft, it's settling a payment when funds aren't in your account. Crypto has said that it won't do that. Part of the promise is you always know that the funds are available in your account. So, there are a lot of ifs in that question. I think crypto has put out a lot of promises to solve real problems and identified true pain points, often pain points that the existing payment system have ignored. The Fed's old system was really predicated on the idea that everyone had $1,000 in their bank account and could afford to wait days for their money to be available. And that's true for, the wealthier half of Americans. On the crypto side, I think crypto would do better focusing on their own technology and their own proof of identity and proof of value and proposition and proof of money in that. I will flag one final point. When the SVB and Signature Bank and all those banks were failing in March, the Fed's actual payment system was slow. And in fact, one of the banks almost failed during the day because at 4 p.m. the Fed closed its FedWire. It's a different payment system, one that's more involved in the FX and other trading that you described, almost caused the bank to fail same day. So a faster back office for the Fed can be a more stable financial system. Why is this important to crypto? Well, we know that had SVB failed and not been bailed out, Circle would have lost a lot of money. And what impact would that have had in the stable coin system, and how would that have reverberated through the broader system? We don't know.
Well, 4 p.m. is the time everyone needs to get out of the office and get home, beat New York traffic or DC traffic, so you got to excuse them.
Well, sure. And 4 p.m. in New York is 1 p.m. Pacific time, right? It's not like 4 p.m. in each time zone with these old antiquated systems. So, what occurs after 1 o'clock, right? When the Fed was founded, the San Francisco Federal Reserve had the same share of the population as the Minneapolis. Today, it is about 10 times the share of the American population. So, what's changed in 100 years?
That teaches them to live in California.
All right. We are going to leave it there. Aaron, thanks so much for joining the show this morning.
Great. Thank you very much.
That was Brookings Institution Senior Fellow in Economic Studies, Aaron Klein. We're going to take a short break. Coming up, we'll take a look at the crypto markets update as we near another Fed rate decision right after this.
All right, take a look at Bitcoin. It's only trading at around $29,000. Traders are waiting for the Fed's next interest rate decision. What will it be? I got a clue. It's going to be raised 25 basis points. But enough about that. Joining us now to discuss the crypto markets is Galaxy's global head of asset management, Steve Kurz. Welcome, Steve.
Thanks so much for having me.
I'm glad to have you here. So, of course, tomorrow, no, it won't be a big surprise. Like the market's 99 something percent, assuming that the Fed will raise 25 basis points. The Fed funds rate, what it charges to banks, will get into a range of 5.25 to 5.5. That's the highest it's been in 22 years. Does it matter for Bitcoin? We've already kind of predicted this. So is it going to matter, or is it going to be what the Fed says that matters?
Well, the Fed always matters, but I think this one is pretty well telegraphed. I think what people are missing, there's two things. One, we're in the middle of a great fiscal experiment. And I think what we're learning in the discrepancy between expectations and the equity market, for instance, around a potential recession, all comes down to this notion that we're just going to have a hard landing or a recession that comes out of nowhere. And really, there's this pent-up demand that may last a lot longer than people expect, and that's an umbrella that affects every market, including crypto. So you can't ignore it. I think the language, it doesn't serve the Fed to do anything other than maintain their hawkish optionality. Now, if the data comes out in a way that does push them to go in the other direction, I do think the market is set up the wrong way. We think there are going to be a slow, steady, easy breeze of cuts, and that's generally not how it goes. So in the event where you do have a flip to a rate cutting environment, you're probably going to have more rate cuts in less time than the market's expecting, which of course could be very impactful to Bitcoin.
Right, not cutting fast enough is almost a rate hike in the mind of the markets. But there is that whole one and done idea, right? That's what we're seeing right now. When you look out into probabilities on the Fed, the Market Watch tool, there doesn't seem to be going. For the most part, doesn't seem to be going higher than this, but that doesn't seem to be what I mean. We'll know tomorrow when there's a statement, but it seems that that's not necessarily how the Fed's looking at it. That we might get another one afterwards. At what point will the market assign the proper weight to a higher interest rate?
It's a great question. I was remembering I started my career at Lehman Brothers on the bond desk, and when I started my career, we were back in these levels, and you always have the tail wagging the dog, and we've since my career began, we've gotten more detail from the Fed and more press conferences and more information, and we still get it wrong in terms of the expectation. So I don't know that I would expect us to get any better. I think that probably one and done is the right baseline answer. We do see the data supporting that. Of course, this will be data dependent. I think the global story is instructive. What's happening in China is instructive. What's happening in Europe is instructive. It's not just the Fed that's on the market's mind this week. You have the ECB, you have the DOJ, you've got big tech earnings. There's really a lot to digest in the middle of a summer week or two, and so.
But none of them are about about lowering rates or saying that they're done. I mean, it seems that all these other institutions are raising rates also because they're looking at their own inflation rates, and they're like, gee, this isn't under control. I mean, we're better off than we were a year ago, but it doesn't mean we're at our long-term targets. The same thing with the Fed. I mean, you're recalling Lehman. I recall when we'd have to look at what kind of sandwich Alan Greenspan was eating to determine where things were going to go. So the Fed now telegraphs a lot more of what it is, and it seems like it's telegraphing we're not one and done.
Well, they need optionalities. It's an election year next year. I mean, the fiscal point is one I'd come back to, right? This is not a normal situation, and they can only control what they can control. In spite of the mistakes the Fed's made, I actually am a little charitable to them in this current environment. I do think preserving optionality around the language and to hike is the right move if you're the Fed chair today, and you don't want to get pushed around. You want to stay in front of the market and keep the hammer. But what else would they do, right? I mean, they're not going to come out and say, hey, we're done here, because they need to see some follow through. And the reality is the data has been confusing.
We could also raise rates and still not have a recession.
Yeah, that's right. I mean, I think buying time is also a part of the Fed's strategy, and that makes sense, right? You want to give the companies that have debt a chance to readjust. You want to give homeowners a chance to readjust. You want everyone to sort of smoothly grow into this new normal of higher rates and rationalization of what we experienced in the last not just 3 years but also 15 years. And so I do think there's a little bit of playing for time that's going on.
Steve, we got to get your outlook on Bitcoin in here. There wasn't a big market reaction to the two lawsuits brought by the SEC against Coinbase and Binance. There was a little dip on the Wall Street Journal's story yesterday. We have the ETF race. What's your outlook?
Well, it makes sense that there's some consolidation here as a starting point. And we've seen that twice already this year, where you've had a range bound for a while. You go below the range, in this case, the 29K. And in both cases, you've had a resumption of the uptrend, which is obviously the bigger picture in terms of the 80% move of Bitcoin year to date. Medium term, obviously, we're very constructive on Bitcoin. It's not just the halving. It's not just the Fed going the other way, potentially. It's also this adoption story that you're so focused on with the ETFs in the U.S. And the global story. I think we're in a pocket here where you may test in these current levels, and there will be support at 27.5, 28K. It's been nice to see 29K holding, but I think the bigger picture, and the vol market is pricing this as well, is that 2024 is shaping up to be a good year for Bitcoin, and there's a lot going on outside of just Bitcoin too that's important to understand when you think about how money's coming into the crypto system and where Bitcoin goes in the short term.
Speaking of short term, we have the end of the week. We have a lot of options at 30,000. Is that kind of what's holding back Bitcoin from falling even lower?
Yeah, there's a little bit of that. I think that the institutional understanding of the Bitcoin story, putting aside the vol date at the end of the week, is actually the bigger picture here. I think that unlike the last bear cycles, you have institutional knowledge around what Bitcoin is, why it needs to exist, and while people aren't telegraphing that because it's still a little bit taboo in a traditional sense to own Bitcoin, under the hood there's a lot more activity. Not necessarily volumes, because obviously that's come down since the bear market, but the general bias and directionality of institutional players has been to start to accumulate Bitcoin positions and to look for good entry points to do that. And so I think the cycle lows have been put in to get to the punchline.
All right, and really quickly before we let you go, we got to ask what your thoughts are on Dogecoin up, I believe, the second day in the row on the back of this ex-Twitter business. What are your thoughts there?
Well, I think in the last segment you were talking about the toilet, so I maybe we'll go back to the but I'm joking. Look, and everyone's focused on Elon Musk. He has fun with Dogecoin. I think predicting the direction of meme coins is a fool's errand. The bigger picture is, you had an XRP decision, and altcoins are on some level back in vogue. So you're seeing some movement out the risk curve. You obviously are seeing, I think, Twitter making big moves and incorporating crypto into the Twitter system, whether it's Dogecoin or otherwise, is a great story potentially for crypto adoption. You're seeing Worldcoin, you're seeing the XRP story, and so there's an interesting story in crypto to be told outside of just when are we going to get regulation in the U.S. and this is obviously part of that.
X stands for Xanadu, one of the biggest flops in film history. Great film though.
That is a great film.
Everyone knows Xanadu. Fantastic soundtrack.
That's true.
But flopped. Absolutely flopped.
Well, I wouldn't bet against Elon. I don't know about on the Dogecoin side, but I think Twitter has a shot.
All right. On that note, Steve, we're going to leave it there. Thanks so much for joining the show this morning.
Thanks for having me.
That was Galaxy's global head of asset management, Steve Kurz. Coming up, we're going to get a sneak peek with a company that's bringing power and crypto mining to Kenya. Stick around to find out what that is right after this. Hello and welcome back to First Mover. CoinDesk's special mining week presented by Foundry is underway, where we take a closer look at the latest advancements and current challenges that remain in crypto mining. Foundry and CoinDesk are both owned by DCG. Joining us now to discuss is Gridless co-founder Erik Hersman. Erik, welcome to the show.
Hey, thanks for having me on, guys.
Wonderful to have you here with us. Let's talk about this micro hydroelectric plant you have in Kenya that ladders up to Gridless's larger mission. I'll let you tell us about it because I don't want to talk at the audience for the next minute. So tell us about Gridless's mission and then tell us about what's going on in Kenya.
Yeah, thanks. So we've been operating on a local hydro facility for the last about 9-10 months. And it started off at this 50 kilowatt site that you see here, where we were just putting in 6 miners to take up the excess load of energy that was being created. And since then, it's grown to a 300 kilowatt site, a little bit larger. We also have on a site about this size, actually it's double this size, Malawi, in the mountains of rural Malawi. And next week, we're opening up a new one in Zambia. So we have 3 country sites. And yeah, it's been quite interesting because I think what most people don't understand about energy, especially energy in Africa, is that we represent a good portion of those people who don't have power around the world. And when you're in these rural areas and the sun goes down, it gets dark pretty quickly. And when you have light, it changes almost everything. And that power allows you to, have kids who can study at night. It allows there to be more security in the community. Helps you to irrigate fields, just all kinds of things. So, I think Bitcoin mining does a huge amount to allow energy to proliferate across the continent.
So it brings you're basically creating these sites that would provide energy, but what kind of infrastructure are you providing to the local communities? In other words, wiring and things like that, and cables, et cetera. How much of your expenses that you do how much of your revenue, how much of your expenses are involved in wiring the local communities that you're involved with?
Yeah, so we work with a local small power provider, usually an independent power producer that is building out that local mini grid. And so we're their largest buyer of energy, and they're the ones who roll out the power. So they're the ones who roll out the grid, and that grid can be fairly extensive. It can cover 5 or 10 kilometer radius from that site. And if you were ever with us on a site visit, you'd see all these cables going overhead, just like you would in any other neighborhood. And that's all provided by the independent power producer and their grid side of the house. And so that includes the customer service side too.
So what part are you providing? In other words, you're just sopping up the extra electricity. So what incentive then does the local power provider have to invest in infrastructure in those communities when they already have a willing buyer for whatever electricity that they have? In other words, like how can you guarantee that some of that revenue, that additional revenue that you're providing the power producer, goes into creating more infrastructure for the communities?
Yeah, so what happens is they've already sunk money into building out these sites, and they've used up about 30 to 40% of their energy on providing electricity to the community, to local businesses and things like that. And they have, somewhere between 70 and, maybe 40% of the energy left over. So we come up there and like you said, we sop up that excess energy. And that's been super helpful for them. It helps them become sustainable. There's not a single mini grid that we've come across in Africa that is financially sustainable yet. And so with us, they're actually able to do that. What happens though is that because they're now financially sustainable, they can look at other things that they haven't been able to do before. So for instance, in Malawi, they were finally able, they had a backlog of 800 families who wanted to be connected to the grid, but they couldn't do so because the power producer wasn't profitable and couldn't buy the meters to connect in their homes. So when we signed on, we became their largest buyer, and they were able to sign on 200 more families within the next 3 months, and it actually connected for the first time. So those are the kind of things that can happen once we come in. Sometimes it also lowers the price of power to the community. It depends. So we see different things in Kenya than we do in Malawi, and I'm sure we'll see different things in Zambia on top of that.
What are you paying per kilowatt?
We don't pay per kilowatt. We don't have a floor price. We come in and we do a revenue share with them. So they make a percentage of the Bitcoin that we make.
Erik, we got to ask you about Greenpeace. They're advocating for Bitcoin to switch away from proof of stake. There's a big campaign about the energy consumption around Bitcoin mining going on right now. What are your thoughts on that campaign? And maybe do you have a response to it?
So about a month and a half ago, I released a document called Blueprint for Energy and Bitcoin Mining in Africa. And in it takes data from about 20 different reports, as well as our own data. And it shows that if you actually want energy to proliferate, we're in energy poverty here in Africa, where 600 million of the 1.2 billion people on the continent don't have power at all. They don't have any energy. So if we want to electrify people who live at the edges, and we want to push that energy further out, back kind of beyond where the current grid will be, then we need to have an anchor tenant that can sign on being a first and last buyer for that energy, so that these independent power producers will continue to build energy. And I think that's the biggest argument for it, right? There's obviously arguments in other parts of the world, but in our part of the world, Bitcoin is offering something that nobody else has been able to do for people who are trying to build out energy. And if you take that away, then you're also taking away electricity for hundreds of millions of people.
Erik, we're going to have to leave it there. Thanks so much for joining the show this morning.
All right. Thank you very much for having me.
That was Gridless co-founder Erik Hersman.
Well, the Fed isn't the only institution in D.C. Lawmakers there are meeting tomorrow and Thursday to mark up bills regarding digital assets. Joining us now to discuss is CoinDesk Global Policy and Regulation Managing Editor Nick Day, who is also the editor of God's favorite newsletter, The State of Crypto. Hi, Nick. How are you?
Good morning. I'm good. How are you?
I'm thrilled. So before we get into it, people might not know American parliamentary procedures. What is a markup, and who cares?
So a markup is the first time, not the first time, but it's when the committees, so in this case, the House Financial Services Committee and the House Agriculture Committee, look at a bill and start offering amendments, giving the members a chance to make their views known and really weigh in on the potential drafting or passage of a bill. It's something that comes before we get to any kind of vote. The bill itself or the bills themselves rather, are under discussion. But really, what it does is gives us a chance to see. Okay, well, here's XYZ lawmakers who think that maybe there needs to be another provision on consumer protection or on stablecoin reserves or whatever. It gives us a more insight into the bill itself as it heads towards a potential vote at a committee.
So we have Patrick McHenry's "Give Me Stablecoins or Give Me Death" bill. Explain that.
So that's the big one, right? This is the one that for over a year now, the crypto industry in particular believed might have the greatest chance at becoming a law. This is a bill, an effort that's been bipartisan. Both Congressman McHenry and Congresswoman Waters, who is the ranking member, meaning the lead Democrat, have been working together on this. The stablecoin bill, we've seen a number of versions, but basically it creates provisions for how the Federal Reserve might supervise stablecoin issuers, how companies themselves could become issuers, or how issuers might have to conduct themselves. It has provisions for things like reserves, for things like algorithmic stablecoins, things like state-level charters versus federal charters. So this is a bill we've seen, I think, 3 or 4 different versions now. This is one of the bills that will be discussed tomorrow during the House Financial Services Committee markup. That's set to kick off at 10 a.m. Eastern.
Another one is called the Financial Innovation Technology for the 21st Century Act. Tell us about that one and what you expect to see there.
So this is a slightly newer bill. This seems to be the not bipartisan, but the by-committee approach with the House Financial Services and House Agriculture Committees. So not just Congressman McHenry, but Congressman Glenn Thompson, who is the chair of the Ag Committee, have worked on this. This addresses things kind of broader to the crypto ecosystem, issues like market structure and such like that. It's not specific to stablecoins or like a subsector, right? This is the one that I have a kind of bigger question on. This bill was recently unveiled, so I don't think Congress has had as much of a chance to really look through it. Certainly, the industry has not had as much of a chance as they've had to look at stablecoin bills. So, I'm not really sure what to expect, but regardless, just the fact that it is going to a markup will kind of, again, give us a sense of what the issues might be that lawmakers have, or, if they don't have issues, how they might look at the vote on this.
Just to reiterate, after they get their Sharpies out and the red pens out and then, they mark it up and do whatever. So the very next step, what happens?
So the very next step is probably we'll continue hearing discussion about this for a little bit longer. At some point, a vote will be scheduled to pass it out of committee. If the bills get passed out of committee, meaning a majority of the lawmakers in the House Financial Services Committee and/or the House Agriculture Committee vote it out, it'll head towards the full House, where every lawmaker will have a chance to vote on this. The ultimate question, though, even if the House passes it, is whether or not the Senate will take it up. So far, we haven't seen much movement in the Senate on really any crypto legislation. Whether that changes in the next couple of months is, to be seen. But that is, at least right now, the part where, this train might come to a screeching halt.
Oh, great.
All right, Nick, we're going to leave it there. Thanks so much for joining us. That was CoinDesk Global Policy and Regulation Managing Editor Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. That's it for First Mover today. I'm Jen Sanasi. Thank you to my co-host Lawrence Lewitton.
You're welcome. I'm glad to be here.
Stick around for CoinDesk's Twitter Spaces at 10 a.m. Eastern today for a conversation on the crypto options expiry happening on July 28th. First Mover returns tomorrow at 9 a.m. Eastern Time. And if you just can't get enough of CoinDesk TV, stick around for the hash. That's happening today at noon. You're watching CoinDesk TV.